All right, you know what day it is. It's Thursday afternoon. It's our weekly state of the market. And unfortunately, here we are yet again with the markets deeply in the red today. NASDAQ down by more than 2%, approaching 3% down on the day. It just seems like we're going to have to move the weekly state of the market to another day because red days have been chasing us and catching us here in the new year. Nonetheless, welcome to our latest edition of State of the Market by Phenom Group. I'm your host, Seth Golden. Let's get down to it this week. We're going to look at some of the internal indigestion of the market as well as some economic data, points of interest, if you will. Most of the time we look at historic data regarding the S&P, the NASDAQ, but this week I want to dive into some economic data to get a good sense of how this the early innings of the 2022 economic cycle are shaping up. We've all heard about the slowdown, but it's important to put the economic slowdown into context, keeping in mind that usually when we hear the term slowdown, it's a matter of a rate of change. Rate of change tends to be the biggest issue with sequential month-to-month economic data points. It's not necessarily that there's underlying weakness. It's just the rate of change. We came from a 2021 where we had above average economic growth. That growth is supposed to slow. The laws of large numbers, we set a high bar, of course. So it's going to be difficult to exceed that, let alone meet it. So in those terms, the slowdown is to be expected from those lofty levels. All right, at the bottom, right, because we have a pretty nasty day, we're still in correction when it comes to correction territory when it comes to the NASDAQ. We're still down a good 5, almost 6% in the S&P 500 after some really fantastic trading days. The final 2 trading days of January, robust rally. The first couple of days here in February continued that rally. 4 really strong trading days, but here we are kind of backing up the truck again one time. Keep in mind, days like today, months like January are opportunities. But at the bottom, stocks will be cheap. Nobody will care. Why? Because they're afraid. They're afraid of cheaper prices. The stock market is the only place that people get afraid when it goes on sale. When it's time to buy, you won't want to. Again, that's the fear. The fear should tell you now's actually the time to buy. That quote from Walter Deemer, when it's time to buy, you likely won't want to. That's the signal to go out there and get it done. All right. Now remember, coming into the year, fourth quarter of 2021, we had more than a 10% gain. And that usually leads, the next quarter is usually very good. 88% positivity rate with a 5% return. Do you think that's going to happen in this first quarter, folks? Let's just say if it's going to happen, the average return, if it's going to happen, S&P 500 has a lot of work to do. It's got a lot of ground to make up. You don't even have to get to the average return. The positivity rate is 88%. So we still got 6% to make up just to get to flat on the year. That's a good sample size here, and we may not make it happen. 2 quarters later, still an 80% plus positivity rate. Momentum. Mentioned that January was a down month. You've heard of the January barometer. As January goes, so goes the year. And we've looked at the statistics for that, and we found that more often than not, the market is still positive by the end of the year or over the next 11 months, but the returns are muted, less than 2%, going back to 1950. Having said that, when it comes to the January barometer, take a look, folks. The January barometer success rate, so after January, all you have left, 11 months, February to December. The January barometer, since the 1920s, look at 70% during the 40s, 90% during the 50s, the 1950s. This is the success rate of the barometer. But notice from the 2000s, actually from 1990, it had a success rate of 70%. Turn of the century, 60%. Since the 2010s, the January barometer had a 40% success rate. And each of the last 2 years, the January barometer was down, and yet the market finished positive. So it's had a zero efficacy rate, in the 2020s. Point is for whatever reason, this barometer, the January barometer, has been less and less and less and less reliable since the 1990s. I thought that was wildly fascinating. Maybe we just throw it out. Anyways, we'll keep it handy. All right, now, prior to today, the VIX has dropped 28% in just 4 trading days. 28%. Usually the S&P 500 forward returns, if we look out 3 months, 63 days later, the S&P 500 has a positive return rate of 76%, and the average return is 4.75%. And there's a lot of signals, folks, especially, since 2020. Volatility spikes, S&P 500 goes down, that inverse relationship. Again, that's usually the time to be buying, not to be running for the hills. All right, this chart right here, I like to blow it up a little bit. There we go. ES liquidity, what does that mean? That's the futures, the futures market. How much liquidity is there in the futures market? You've heard the saying, if you want to move the S&P 500, you've got to move futures. Now, since 2016, we've seen the futures liquidity die off. So when they talk about the market, not the credit market, but the equity market having very little liquidity, they're referring to the S&P 500 futures, or the ES minis, if you will. And what do they mean by low liquidity? Well, what that means is, just like any contract, just like any stock, you have a bid and you have an ask. The spread between those two is the liquidity. The wider the spread, some stocks it's pennies, other stocks it's a dime, 20 cents, 30 cents. Think of a stock like Amazon. The spread is very wide. Chipotle Mexican Grill, the spread is very wide. Those have lower liquidity. Need to use limit orders with those stocks. It's the same thing with the S&P 500 futures. And so when they say that it has low liquidity, they're referring to the amount of S&P 500 futures contracts within $1 of the ask. And over the years, it's really, if you go back to 2016, we used to have 300 contracts within $1. This is how many contracts are available within $1 of the ask. But this only goes back to 2018, but I have experience in this because, in terms of trading volatility, it comes in handy to understand the dynamics, the internal supports and or gives within the overall market. So we used to have 300 contracts. Look at what we have now, folks. I mean, we're literally at the worst level since the pandemic. At the worst level since that whole Q4 2018 20% correction. Remember that? So what do you need to know about this, right? What you need to know when it comes to market liquidity is that in low liquidity regimes, which this obviously is, and it hasn't gotten better for the last 6 years now, more than likely it's not going to get better. Why? Because too much passive investing. Index ETFs, sector ETFs, just too much passive investing has led to, it's one of the reasons. What you need to know is that markets in low liquidity, that markets that have low liquidity will overshoot in both directions. Not only will they overshoot, they move very, very fast. And think of the January drawdown in the S&P 500. I mean, it was one of the fastest near corrections that we've had in a long, long time. Markets move very fast in low liquidity environments. Here's another thing to consider in terms of market liquidity. Trends can become extremely protracted in either direction. Think of liquidity like the Titanic. The S&P 500 is the Titanic. It's in the sea. You drain all of the liquidity out. You drain the ocean away from the Titanic. It sinks to the floor bed, the sand bed. That's the S&P 500. How do you now, without liquidity, change the trend? You need something exogenous. You need a big force factor. It's also one of the reasons why we've had, very minimal drawdowns in the S&P 500. Think about 2017. The biggest drawdown was less than 3%. Last year, barely 5%. Low liquidity regimes, market trends can become very protracted in either direction. In order to move that Titanic, you need something of force. You need exogeny. Hence the pandemic, right? That stopped, the bull market run from, 2019 into 2020. All right. What was, okay. Wanted to update the 1982 analog that we've been following, right? And we were looking for that spike into month end of January, and lo and behold, it happened. So far, the 1982 analog has been holding up extremely well. Now, it doesn't have to, track it to the exact day. We're not looking for exact days. It just so happens that it has been doing that until the start of February, because in 1982, start of February, it rolled over the first trading day. Well, we're on the third trading day and it's rolled over. So it doesn't have to be that precise. Nonetheless, two key points of interest to add to the 1982 analog that just happened. Well, think about this particular spike at the end of the month in 1982. And what just happened here in the final trading days of January. We had 4% plus gain in the final two trading days of January. The last time that happened, 1982. You know what else happened in 1982? The Cincinnati Bengals went to the Super Bowl. You know who's going to the Super Bowl this year? The Cincinnati Bengals. Shout out to my friend Ryan Dietrich at LPL Financial. He's a Cincinnati fan, and I wish him the best of luck. But there are a tremendous, look at the bullet points. Both decennial years, obviously, midterm years, second presidential cycle year. Both years, the CPI achieved 7%. Both are post-recessions. I know that the recession was, not called an end until November of 1982, but we were out of a recession, like in early 1982. The NBR, they'll name it when they want to. I wouldn't go by. It's a post-recession year. Both had down Januaries. Both had a bearish toy barometer. And in 1982, the Fed hiked 3 times in the first quarter alone. And we're going to get rate hikes here in 2021, barring anything exogenous. And yes, I know, Ukraine, Russia could kind of spoil the Fed's plans. We'll see. We'll see. All right. Big rallies to end a month don't tend to last, right? That nice 2-day rally that seeped into February. I wish I could say that bode well and that had momentum that begets momentum, but typically it doesn't. Now, these are all gains of 4% or better going back to 1957. At the end of the month, the next month, market is actually down. Only 30% of the time was it positive. Just saying. And again, the only other time the S&P 500 gained more than 4% the final 2 days of January, 1982. Not totally random. Here's another chart. Down at least 4% in January. That weakness tends to follow. February, only 31% positivity rate, the average return, down 1.68%. The full year, it ain't so good either, unfortunately. Only 38% of the time positive. Most recently, 2016, but that was positive, and before that, so actually, the most recent 2 times it's happened, the market has been positive. Recession year 2008, almost recession year 2000, 1990 into a recession year 91. A lot of these are happening in recession years, 1981. So keep that in mind. This is not a recession year. Maybe that's kind of the variable, that will play out. We were not in a recession in 2016. We were not in a recession anymore in 2009. Positive. We were not in a recession in 1978. But the yield curve did invert, and we'll get to that in a little bit. Okay, we are in a midterm year. Midterm year since 1950. February's performance in midterm years, just February's performance generally improves with average returns all increasing. Since 1950, midterm years, Dow Jones, S&P 500, average return 0.5%, up 10 times, down 8 times. And NASDAQ is 50-50. The Dow has the best performance, up 12 times, only down 6 times. Best positivity rate, I should say. All right, all instances of the S&P 500 gaining 5%, which we did. S&P 500 has gained 5% over 3-day winning streak, while also closing down 5% the trailing 20 days, i.e. January. It's pretty rare. It's happened 12 times before. This goes back to 1970. August 2015 was the only instance remotely similar given how close we are to all-time highs. There's a lot of red on here, folks. Now, this is a short-term study by Steve Depp. Good study nonetheless, but it's a short-term one. We're talking days out to 20-day return. So one trading month. And the best positivity rate is basically the 10-day, which is only 54%, and 20-day, 54% also. So again, we're seeing that declines to the magnitude that we have had in the previous 20-day trailing 20-day period. It tends to linger. All right, this just happened. NASDAQ composite rallies greater than 3% on back-to-back days. Right, that is what just happened. Like I said, it was very strong, this recent rally over a 4-day period. 2 of those days had the NASDAQ up 3% each day. The NASDAQ composite rallied 3% or greater on back-to-back days following at least a 6-month low. Remember, we got down to a level that we hadn't seen since July, 6-7 months ago. So those are our criteria. And the sample size is small, folks. This has not happened very often. 1987, which nobody likes to see that, that statistic. 1998, and I'll get back to this, 1998, 2002, right? And that led to the 2003 rally, took us all the way to 2008. Nobody likes to see that number anyway. And 2022, just now. So really, it's only happened 1, 2, 3, 4, 5 times previously. But the average return a year later, 47%. Now, I said I wanted to get back to this 1998 because, and some of you might remember, our 1998 to 2000 analog for the NASDAQ. Okay, and look at that, right on time. Now recall, the analogs are not supposed to be perfect in terms of the magnitudes of drops or pops in price. When we look at an analog, we're looking for price trend over time, the path. And the path has been the same, which is higher, 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 higher over time. Now, this is an unhealthy move in price along this path. Our journey since 2020 has been a much healthier path. But the correction here showing up right on time in our 1998 to 2000 analog. All right, so again, the NASDAQ composite rallied 3% on back-to-back days. It averaged a return of 40% a year later when that has happened. We've looked at this chart before, the midterm seasonality. Folks, if you think the first month and 3+ trading days of the calendar year has been difficult, look at the May to October returns and look at number of positive times during midterm years and number of negative times. That's a May, June, July, August, September. That's a 6-month window where maybe you gain 2%. Other times, look at the declines, folks. I mean, a lot of double digits are showing up here. Only, the positivity rate is just above 50%. Midterm years, however, we know they're higher 80% of the time. On average, midterm years up 11.5%. That May through October period, again, if you thought January was difficult, we know that we usually don't trough until around July, August in the midterm year. All right, so this goes back to 1942. Let's stop at 1980. A lot has changed since, the 1940s, that's for sure. A lot has changed since the 1980s. But let's just start at 1980 in terms of midterm years. The annual drawdown since 1980, about 14%. Odds of a super bad year, though, the worst years in the 4 decades, so 1980 to present, 4 decades, happened during recessions. We'd really have to tip into a recession to have a double-digit decline. That's what these circles are. These are recessionary years. Going back to 1970, if we were to go back to 1970 and 1974, those were midterm years. Those were also recession years. So if we're going to have a really bad midterm year, we really do need a recession. I shouldn't say need, nobody wants that, but nonetheless. These are the rate hikes by banks because we know rate hikes are coming soon. Barclays says 3, Morgan Stanley 4, Citigroup 5. Look at these bastages over at Bank of America. Forgive my Hebrew. 7, and balance sheet runoff in July. Goldman Sachs 5, and balance sheet runoff starts in July. JP Morgan, they raised their expectations of rate hikes from 4 to 5. Balance sheet, they say second half of the year. I'm of the opinion 3 and done. If they feel they need to go beyond 3, Phenom Group feels if they need to go beyond 3, they're probably going to start contemplating yield caps. In other words, yields can only rise so much. We'll see. This is something that they've already talked about back in 2020. They've been doing research on it. They did yield caps in the post-World War II era, if you recall, or just after World War II. So that might be something that they revisit. Now, we haven't had the first rate hike yet, but is the correction that we've had already, because we were down 12% intraday last Monday before we had that magnificent, intraday reversal. But is it normal? Yeah. This is the first Fed rate hike dates going back to 1955. And the average decline around that first rate hike is about 11%. So we done did it, at least on an intraday basis, 9% on a closing basis for the S&P 500, the drawdown from peak to trough. Perfectly normal. One of the things that we've been keeping an eye on lately in the Phenom Group trading room, and I would encourage our YouTube audience to also keep an eye on it, is the yield curve, because the yield curve is flattening. Now, when it gets thrown about in social media and when you hear about it on the financial news media networks, they propose that it's something ominous. When in reality, we know that most people use the yield curve, most institutions and economists, they use the yield curve as a recession indicator. When the yield curve inverts, there's usually a time between that inversion and an actual recession. How many months in between the yield curve inverting and the recession ensuing? Most people use the yield curve. The spread between the 2-year treasury and the 10-year treasury is deemed the yield curve a consequence. And that's the one that most people watch in terms of it inverting. When the yield curve moves towards the zero bound, we call that flattening of the yield curve. When it moves away, meaning the spread between the 10-year and the 2-year treasury yield widens. So when the yield curve moves away from the zero bound line here, we call that steepening the yield curve. Steepening is better for banks, financial institutions. They get more net interest rate margin on their loans. So again, we call that steepening. Flattening is when it moves towards the zero bound line. And inverting, of course, is when you go below zero, inverting the yield curve. So this chart right here, so this is why I say kind of pay attention to what the market does as opposed to what financial media says. So you notice what's happening here. The green line is the yield curve. The black line is the S&P 500. We're flattening, right? When the line's going down, we're flattening. We're getting closer to that zero bound. But look what the S&P 500 is doing. It's rising. Flattening here again. Look what the S&P 500 is doing. It's rising. We inverted the yield curve a few times back here, and then you get your recession. Here we are again. We're flattening the yield curve. Here's the S&P 500. Look what it does. So, while the financial media focuses on the flattening, they tend to, again, it's about lead time to a recession. We know that financial media, social media, they like to fear monger. So the flatter it gets, the recession's coming, tweet, tweet, tweet. But the reality is the S&P 500 does quite well. Flattening the yield curve, even though it's quite far from the zero bound line, S&P 500 is going higher, higher. Flattening from 2015 all the way to 2019, where we inverted the yield curve for all of 3 or 4 days. Indeed, we had the pandemic-induced recession. These gray lines here are recessions. Inverted. Now, does the inversion of the yield curve cause a recession? No, of course not. But it has been a very good indicator that financial conditions are tightening, and lo and behold, we get a recession, usually upwards of a year or so. We'll get to that in a second. But again, just because the yield curve is flattening, that is not bad for stocks, folks. You see what the S&P 500 line is doing. This chart right here, this goes back to 1978. It looks at all the times that the yield curve has inverted. 1978, 1988, 98, 2000, 2005. Now, indeed, we had the yield curve inversion as well in 2019. That doesn't show up on this chart. But we know what the S&P 500 did after the yield curve inverted in 2019. 2019, the yield curve inverted in August, and the market rallied another 11% over the next 6 months up until COVID. So over here, in this far right-hand corner, you can see 12 months later, after all of these inversions here, these prior 5 inversions, 12 months later, market on average up 11.6%. Now, from the date of the recession, from the date of the inversion, months to a recession for each one, this was 17 months, 19 months, 34 months, 14 months, and 24 months. I mean, more than 2 years on these 2 occasions before we actually had the recession. This was in 2005, December, so the end of the year. And then in January of 2008, they called the recession. It can be as much as 2 years, but the average is 22 months. Average is 22 months. That's just from 1978. Now, we've had inversions prior to that. If you go back to the 1960s, include the 1960s yield curve inversions, this gets reduced to just 14 months. So your starting point matters, obviously. All right. Point is, yield curve inversion, not the end of the world. What would be the end of the world if the housing market goes into a recession or a major slump? Why? Because the housing market is extremely, extremely important. Some people call it the business cycle. The housing market is the business cycle. Why? Well, the housing market, you get residential investment. When people buy houses, they buy stuff to go in those houses. Secondarily, it creates jobs, construction jobs, financial industry jobs, mortgage originations and loans. It's great for banks. A lot of jobs are tied to the housing market. Housing has a volume cycle. It's important to understand housing has a volume cycle, not a price cycle. Home prices, they're very sticky downward. Meaning it's hard to get home prices to go down. Home prices are very sticky downward, and faced with a decline in demand, it is the volume of sales that adjusts, not the prices. With the decline in sales volume comes a decline in jobs and construction and finance and real estate brokerage. Don't forget, like when we talk about GDP, the P in GDP refers to production. The appreciation of your home is not production. It doesn't count as GDP. But jobs in construction, finance, and real estate do count. Thus, volumes matter, not price. Volume. This right here shows you want GDP growth to be sticky. You want to worry about the housing market, the economy? Look at construction spending. That's residential. Look at that. You're worried about we can't build enough houses quickly enough at ever rising prices. And you're worried about the economy? Stop it. Here's something else. You're worried about the economy? Ward's, they're a auto industry tracking institution. They just announced the December auto sales this week. Look at this, folks. You're worried about the economy? This is after the child care tax credits have ended in December of last year. Look at this. Remember at the beginning of our weekly State of the Market, we talked about rate of change. Child care tax credits expired December last year. We can still, based on this graph here, we can still see strong retail sales growth in the Johnson's Red Book retail sales on a year-over-year basis. We're still growing. First week of January, 14, 15, 15.6, 15.8% on a year-over-year basis. That's double-digit retail sales. Is it as high as December? It's not supposed to be as high as December, the holiday retail shopping season, let alone November. It's not supposed to be. Like I said earlier, most of this economic slowdown is rate of change. It's not a weakness in the underlying weakness in consumer spending. It's not. It's just rate of change. It's seasonal to a goodly extent. Costco wholesale. This is by Bank of America. They have, they track Costco's sales. January comps accelerate on a 2-year stack basis. Does this sound like something you need to worry about in terms of the consumer, let alone retail sales? Here's the other thing. What helps to support the longevity of an economic cycle, expansion cycle, is capital expenditures. Get the 2-year growth in capital expenditures by the different sectors of companies in the S&P 500. The year over year, just the year over year. So from last year to present, based on what's already been reported by companies, 38% growth, ex-Amazon, because Amazon hasn't reported yet. They will after hours today. My cough drop. But even a 2-year growth comp is 20%. Companies are spending. They're investing. That's how you grow. How else can we see the strength in the economy? Cash freight index. Look, we need constantly replace these goods that are being bought off the shelves at retailers. If all of a sudden that stops, well, we know where we need to go. We need to go to the shipping and freight transportation indices to see if there's weakness there. If there's weakness there, there's ultimately going to be weakness in retail sales. Does the cash freight shipping index show weakness, folks? Now look, this goes all the way back to 2010. We're at extreme levels here. This should roll over, and hopefully it does, because there's a price component within this index. But right now, cash freight shipping index, and there's all kinds. You can look at the Baltics dry index. You can look at the Harper freight index. They're all at extreme levels. This is not recessionary conditions. This is not even a slowdown, folks. What just got back above its 50-day moving average? The transportation index, the IYT, which is an ETF of the transportation stocks, just got back above its 50-day moving average. Retail is not doing very well, but as this goes, usually this follows in the not too distant future. Again, assuming we're not going into a massive correction in the market, assuming that we do have this expansion cycle continuing and post the Omicron stuff. I want to call it something else. Being nice when I say stuff. Anyways, jobs, right? We're not going to have good jobs numbers when it comes out tomorrow, the non-farm payroll report, because of Omicron. That's why I said I'm going to be nice and call it stuff. Because, people stayed home. People were scared to go back to work. They didn't want to get Omicron, especially as infectious, as contagious as it proved to be. But here's something else. The JOLTS report, which is the Job Openings and Labor Turnover Survey, is at record levels. The number of job openings are pretty much at record levels. It's not just that, but there are 4.6 million more openings than we have employed people. What does that mean? In layman's term, that basically means employers are willing to hire. If employers are willing to hire, it means they must feel good about their future sales and earnings prospects. This is a good thing. This should naturally mean revert over time as more and more people go back to work. Last 2 weeks, we've had drops in the initial jobless claims, which is a great start for the February non-farm payroll report. But right now tomorrow we'll be dealing with the lackluster non-farm payroll report for January, which may even have a decline because of Omicron. We're getting past that, as we see in the initial jobless claims report. Inflation, right? We're running at a 7% inflation rate. Is that so bad? Here's the thing, folks. The service side, the lower income, the lower paying jobs and whatnot, they've actually offset. Their wages have risen more than 8% on a year-over-year basis. They completely overshot the rate of inflation. So again, no wonder retail sales are growing year over year. That lower income, that service industry employee is able to, do pretty well in this inflationary environment because their wages are moving at an accelerated pace higher. Your management, your supervisory level isn't. But guess what? They get paid an exorbitant amount. Okay? Boo-hoo for those guys. The little guy win one for a change. At the end of the day, what moves markets? Earnings. Here's something I had tweeted out earlier. Thought this was, with the graph. Wage growth in lower paying jobs has offset inflation, creates very tight labor market, but strong demand, strong consumer spending. We have higher inflation, higher wages, higher earnings. We have a low unemployment rate, high profit margins, high stock prices, which create a wealth effect. You get this feedback loop. Help me find a problem here, people. Help me find a problem here. Could the Fed disrupt this whole thing? Could. I don't think it's in their best interest, and they don't believe it would be in their best interest. That's why they remain data dependent. With that, I'm Seth Golden. Thank you for joining me this week on our State of the Market.